Investing your money can be confusing. Confusing like a monkey doing math, but the truth is, 90% of reaching your money goals is getting the order right in types of investments, putting your money to work where it will work best for you. I'm going to walk you through each of the 9 steps for your money, the optimal order for investing, along with the returns you can expect, as well as the pros and cons for each. This first step here to investing your money may not sound like investing at all, but believe me, having an emergency fund will make or break your other investments. Folks, one of the biggest risks to reaching your investing goals isn't your ability to pick that next 10x stock. It's not how much you make or how much you invest. It's being able to keep your money invested and make it work for you. And besides getting your investing advice on TikTok, the number one thing stopping you from staying invested is emergency bills. A recent report by the Consumer Financial Protection Bureau found household financial health in the decline, with 1 in 3 households facing a major unexpected expense costing hundreds of dollars, and 1 in 8 with lost income over the last year. So ask yourself, how would you pay a $1,000 emergency expense right now? If you're like nearly 5 in 10 Americans, you'd have to sell your investments or go into debt. That is why this first step is so critical, why everyone needs some money set aside for these emergency expenses. I'm not going to sit here and say that you have to have 3 to 6 months worth of expenses saved before you start investing. That just ain't going to happen for a lot of folks out there, and I don't want you saving forever before you start investing. I want to be realistic here and say start with an emergency fund of maybe $2,000. That's going to cover you from most of the unexpected expenses you'll find and will keep you from having to sell your investments. Now, you do not want this money in stocks or bonds or even other investments that we'll talk about. This is money that you could need in a heartbeat, so it has to be in cash, something like a money market fund or a no-penalty CD at the bank. No, you're not going to get much of a return here, and that sucks, but that's not the point. The point is to have this money safe and available in a minute's notice, so that saves you from that cycle of debt and eventually bankruptcy. This next step, investing in your 401k, is the best return you will ever make on your money. I want to repeat that. Maxing out your employer match on your 401k is the best return you will ever get on your money. Because think about it, not only do you get that tax break on any money you invest in your 401k, so that's going to save you 10 to 40% right there. But your employer is giving you that money to invest also. Even on a half-match program, you're getting an instant 50% return on your money. Nation Warren Buffett is possibly the greatest investor of all time, producing a 16% annual return for Berkshire Hathaway investors over the last 40 years. But you can beat Buffett's return simply by investing in your 401k. And that's why it's so unbelievable, so crazy that tens of millions of Americans do not take advantage of this. More than 2/3 of employed Americans, 91 million people, have access to a 401k program at work, but only 60 million people invest in it. Now, you can invest as much as $22,500 in your 401k program, but I want you to start with just maxing out the company match. This is that free money that everyone should be getting. So if your employer says contributing up to 3% of your income, that company is going to match a certain amount of that. Make sure you're contributing that 3%, just whatever it takes to get that full match. Now, that won't be enough to live on in retirement, but at least you can afford top ramen instead of the cheap stuff. What it will do is put you way ahead of the average 401k balance. We'll use the median balance here because the average in this chart is skewed by those super high savers. The median is that point where half of 401ks are above and half are below, and you see that that's not a good picture for most Americans. The median 401k balance by retirement is just $55,000, or enough for an extra $200 a month. But look at how easy this is to beat. For example, making $42,000 a year and contributing 3% of your pay to that 401k program that matches you 50%. That's the average match program across 401ks. Over 30 years, you will have invested just $70,000 of your own money, the red line at the bottom. And your employer would have matched that for $35,000 in free money. Even with a modest 8% return, you would have a nest egg of nearly $350,000 in your 401k. Now, yes, the downside here is that you aren't able to touch that money until you're 55, and the fund options are pretty limited in a lot of these programs. But again, this is the best return on your money out there, and it absolutely must for every investor. We'll get back to our list, but first, if I was to ask you what the biggest risk to your investments, what would you say? Not picking the right stocks, maybe that recession or a stock market crash even. Nation, the biggest risk to your money is not having an investing plan, or worse still, not having one that's right for you. That's why I created a quick 3-step guide to making your investing plan. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing, and that is customized to your needs. I'll leave the link to that and 2 other investing guides below in the description. It's totally free, just something I wanted to put together for you out there in the community. So click through and get your step-by-step guide. And here, another way to get a guaranteed return on your money, paying off your high interest rate debt. And here we're not talking about your mortgage or your car loan yet. Here we're talking about those credit cards, the personal loans, and the other debt with rates of 15% and higher. A return on stocks have averaged 8.5% over the last 40 years. And while you can get a slightly higher return from some of your tax-advantaged programs, anytime you can get a guaranteed 15% return, you take it, because that's what you're getting when you pay off that high interest rate debt, a guaranteed return from not being stuck with 15, 18, or even 20% interest. And okay, because paying off that debt is about as fun as a fart in a fan factory, I want to share my favorite way to pay down debt, the debt avalanche method. That debt avalanche method means making the minimum payment on all your credit cards and loans each month, but taking anything extra and paying down the highest interest rate debt first. So focusing on that higher interest rate debt first is going to save you thousands of dollars that you can then use to pay off all your debt. That's the reason they call it the avalanche method, because it's the debt payoff system that just builds and builds and gets you debt free. Your next step after paying off that high interest debt, that week-long bender in Las Vegas. Okay, this isn't an official step on the list, and maybe don't go to Vegas and get yourself right back into debt, but I want you to have fun with your money. I know, it's advice you didn't expect from a how-to money video. It's something you won't hear on other channels where you get that monotonous, endless cycle of budget, save, invest until you die. But nation, I don't want you to be miserable millionaires. I don't want you to look back on your life, counting all your money in your 60s and wonder, what the hell was it all for? When did I ever really live? We are coming up on some of the best investments you can make for your future, but I also want you to live for today. So I want you to set aside a little each month for your Live a Little fund. The power of this is by including your family in that planning for how you're going to use this money every year, even every few months. You get everyone on the same page with your savings goals. Plan something small each month and something bigger a few times a year. Now, this doesn't mean break the budget and stop investing for the future. It means having a future, but also a present that doesn't burn you out on a budget. Speaking of investing for the future, one of the best ways to do that is through an IRA or Roth IRA. The return on an individual retirement account, or IRA, isn't going to be as good as your 401k because you're not getting that free money from a company match, but the tax advantages here still make it a priority for investors. For example, investing $6,000 a year on a 7% return grows to over $379,000 in 25 years. Try investing that same amount in a regular taxable account as a high-income earner, and you're giving up over $72,000 to Uncle Sam in taxes. That's because of the tax-free investing you get each year with an IRA, being able to invest your money before income taxes are taken out of your check. You can set up an IRA with any broker, including Vanguard or Fidelity, and invest up to the $6,500 maximum each year. Unlike 401k plans, where you're limited to those funds offered by the plan, with IRAs, you can invest in any stock or fund you want. Now, that tax-free advantage does go away for higher earners, and depending on if you have access to a 401k plan at work. If you have a 401k plan, you get full IRA deductibility if you make $66,000 as a single filer, or up to $105,000 for married couples. If you aren't covered by a 401k plan, you can make up to $198,000 as a couple and still get that full tax deduction or no limits on single filers. We're moving on to stocks as an investment next, but you'll notice I'm not including 529 plans on this list, a tax-free way to save for college. Now, I'm not saying people shouldn't get an education, and these 529 state plans are a great way to pay for it, but I feel like these aren't must-haves like those other investments and retirement funds. I love my kids, and I want them to have better than I did, but I also think 18 years is enough to be paying their bills. Let me know, though, in the comments what you think. Should a 529 savings plan be on this list, or what other investments do you think should be here? We're finally ready to invest in the stock market, and what will probably be your biggest investment. Now, up to now, you've been limited to how much you can invest in each step. You only need a few thousand in an emergency fund, and your company is only going to match you so much in your 401k. Even some of the steps after this one, you'll want a limited investment in those. Bonds are a good safety net, but don't offer much growth, and even real estate underperforms stocks over the long term. Stocks, though, this is where you put your money to grow. Stocks are an ownership of a company. With how easy it is to buy and sell stocks online, it can be easy to forget that, but when you're buying a stock, you are becoming an owner in that company. You not only get the dividends that the company pays out, but your investment grows along with the company's business and its profits. Now, most investors should have between 50 to 70% of their money in stocks, depending on your age and how much risk you can stomach. Hell, many investors have as much as 100% of their money in stocks, but I hope after watching this video, you'll spread yours out in some of these other steps as well. Having everything in stocks might sound like a good idea for those higher returns, but it's just setting yourself up for failure during a stock market crash. Now, you'll hear all kinds of rules for how much you should invest, whether it's 10 or 20% of your income, but I want you to start small here. Invest only as much as you can consistently save each month. In fact, even $50 a month invested at a 9% annual stock return will grow to over $80,000 in 30 years. Now, it's not enough to retire, but for less than a daily mocha coca frappuccino, you can get started on your nest egg. Investing $200 a month gets you to nearly $330,000, which is more than the average at retirement. And stretching it to $500 a month invested in stocks builds you a $800,000 portfolio. So just start slow. Remember, you're still enjoying the present while saving for your future, and gradually increase how much you invest each year. As for returns you can expect on stocks, we see here the annual returns for different investments from 2008 to present, including stocks, bonds, and real estate. I'll highlight large cap stocks here. Stocks of large companies have the highest average return at 8.8% over the 15-year period, with just 3 of those years seeing losses. Now, that doesn't guarantee returns in the future, but positive returns in 12 of 15 years is pretty darn good. Most investors have almost nothing in bonds, but I hope that changes for you after this video. Bonds come in all types, like the burrito bonds issued by food chain Chilango that come with free food, or Bowie bonds, which paid interest on royalty payments from Bowie's pre-1990 records. But most bonds are loans to governments, companies, or even local projects. They pay out a fixed interest twice a year and then pay back the loan amount at maturity, which can be as short as a week and all the way up to 99 years. I'm putting together a complete video on bonds, but I want to give you the basics here, the benefits, and why every investor should have some money in these fixed income investments. And the easiest way to invest in bonds is through an exchange-traded fund, an ETF, a bond fund managed to hold hundreds, even thousands of separate bonds. Now, these ETFs never mature, so you don't have to worry about rolling over your money into a new investment. The fund receives interest payments and then makes those regular dividend payments to investors. A good example here is the iShares Investment Grade Corporate Bond ETF, ticker LQD, a fund of over 2,600 bonds of highly rated companies like JP Morgan, Apple, and AT&T, and pays a 3.6% dividend. Another example is the High Yield Corporate Bond ETF, ticker HYG, a similar fund of almost 1,200 individual bonds, but this one holds companies with a little lower credit ratings, like Dish, Tiva, and SiriusXM, while paying a higher 5.6% dividend. Now, since bonds are that debt obligation, the contractual obligation, it's a more stable investment compared to stocks. Bonds pay that fixed interest twice a year, no matter what, so you get that stability compared to the ups and downs of stock prices. The downside, of course, is the limited upside return. Bonds pay their fixed interest, and that's it, so don't expect much price return on these. Here we see the return on 2 types of bonds. First here is the investment grade bonds, the AGG bond index of government and highly rated corporate bonds, with a 2.6% average return over that 15-year period. It might not seem like much, but the best year for bonds are usually the worst for stocks, so it helps even out your portfolio. We also see here this high yield bonds, those of less highly rated companies, and these offer a higher return, averaging 6%, though there is more risk. You'll get a higher dividend with these high yield bond funds and only marginally more risk. And we're coming up on one of my favorite investments, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. No other asset class has created as much generational wealth as real estate. As the man said, they just aren't making any more of it. I started my career as a commercial property analyst, so there's always going to be a special place in my portfolio for property. There are lots of ways to invest here, from direct purchases, investing in loans, house flipping, But for this video, I want to keep it easy with the simplest way to buy real estate through real estate investment trusts, or REITs. REITs are companies set up solely to own and manage property, and in fact, get a special tax break if they pass on most of their income to investors. That means no corporate income taxes and a high dividend yield for these stocks. The pros of investing in REITs are a higher return than bonds. You get a strong dividend yield plus price appreciation, while REITs also help smooth out those ups and downs in a stock portfolio. The downside here is, especially compared to just buying real estate directly, is that REITs prices tend to behave like stocks, so there is a little more volatility. REITs posted a 6.6% average annual return over this period here, but that includes a 37% plunge during the 2008 crisis, and I think the real long-term average can be closer to 7 or 8% return. What was very interesting here, though, was that real estate stocks were the top performing asset in 5 of the 6 years following that steep 2008 sell-off. We're seeing another sell-off last year and this year on those higher rates, which leads me to believe when a current weakness is over in a year or two, real estate may once again boom higher. Now, this next step isn't one every investor will take, investing in alternative assets. These alternative investments are going to be things like investing in startup companies, hedge funds, commodities, or private equity. These investments might have special requirements like the SEC accredited investor rule or minimum investment sizes. There's also a lot of unique risks here, which is why I recommend getting started with just the basics first, the stocks, bonds, and real estate that every investor needs before you worry about these alt investments. When you're ready though, these investments can be some of the best returns you'll find. Research by Willamette University on startup investing by angel investors shows an average multiple of 2.6 times your money over a 4-year portfolio periods. That's a 27% annual return. For their part, hedge fund returns are similar to the stock market, but on less risk. And even though cryptocurrencies have busted over the last year, there have still been millionaires made over the last decade. Those higher potential returns are going to be a pro of alternative investments, while another is the fact that returns don't follow stocks up or down. Like bonds and real estate, that's going to help smooth out your portfolio when stocks crash. The cons here are the increased time to research these and the potential for a total loss. These investments are very much different from what you're probably used to, so take your time with this. Get comfortable with these alt investments before you invest much money. The beauty of these, though, is that you can invest just 10% of your portfolio. And if you have just a few of these investments do really well, like 10x your money, it can still be a big boost to your overall wealth. I wouldn't have more than 10 or 15% of my money in these. And again, don't feel like you need to invest anything, only if you want something more than stocks, bonds, and real estate. Now, this step, paying off your low interest rate debt and your mortgage, is the only step you might consider taking out of order. Of course, Dave Ramsey would disagree. Dave would have you pay off that mortgage first, do your debt-free scream, and then worry about making your money work for you. And yes, there is something to be said for getting the stress of debt off your shoulders. Debt can be a 4-letter word for some people, and the satisfaction from being debt-free is priceless for them. But not for everyone. More than half of American homeowners have a mortgage rate under 4%, while even safe bonds are expected to return between 4 and 5% a year, with stocks as high as 8% a year. And those Vanguard estimates are likely conservative, but either way, why pay off a mortgage with a 4% interest rate, interest that is tax deductible, so the after-tax rate is more like 3.5%? Why get that measly return when you can invest your money instead for a return twice that? Look at it this way. If instead of paying off your $100,000 mortgage, you invest it and earn a 9% long-term average from stocks, so each year you take $6,500 of your stock returns to make your mortgage payments. In 23 years, not only would you have paid off your mortgage completely from that $100,000 that you were going to use it anyway, you will have grown your nest egg to over $250,000. You can have both. Pay off your mortgage and invest, so don't feel like you have to wait to invest. If owing that mortgage debt is keeping you awake at night, then by all means pay it off now, but don't feel like you're trapped by those money rules that just make no sense at all. If you can earn a higher return on your investments than your mortgage rate, then invest first and pay off as you go. Get your free quick start guide to creating an investing plan with the link below, or click on the video to the right for the 7 monthly dividend stocks that will pay your mortgage. 7 stocks for cash flow every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.